Hey everyone, welcome back to Corporate Decoder. Today, INVO Fertility Incorporated just filed its quarterly report, its Q1 2026 filing. And I am seeing a few key numbers that tell a really interesting story about where this company is headed. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is trying to grow fast by buying other clinics, but the financials show a real struggle to actually make money and a big challenge in just keeping the lights on. Alright, let's dive straight into the financials for INVO Fertility Incorporated, which trades under the ticker IVF. Looking at their balance sheet for the 31st of March 2026 compared to the 31st of December 2025, we see their cash went from about $2 million to nearly $5 million. That is a nice jump, which likely comes from them raising money. Their total assets grew from about $20 million to over $24 million. This increase is thanks to things like a bigger cash pile and more goodwill, which is an accounting term for the value of things like brand reputation or customer base that are hard to put an exact price on. But on the flip side, their current liabilities, meaning the bills they owe within a year, actually went down quite a bit. They went from over $10 million to about $6.3 million. This is good to see, as it means they are paying off some short-term debts. Now, looking at stockholders' equity, which is basically the owner's stake in the company, it's significantly increased. It went from about $7.2 million to over $15 million. This boost is largely due to new money coming in from selling preferred stock, like their Series D preferred stock, which they issued 400 shares of in this quarter. Now let's look at how they did business during the first 3 months of 2026 compared to the same time in 2025. Their total revenue went up from about $1.6 million to over $2 million. That is a gain of about 23%, driven mainly by their clinic revenue. This shows they are bringing in more money from their core business of running fertility clinics. However, even with more revenue, they are still losing money on their day-to-day operations. Their operating loss widened from about $1.2 million to nearly $1.6 million. This means that even though they are selling more services, their costs are going up even faster. And take a look at this, a loss of almost $3.8 million related to changes in the value of their warrants. This is a big accounting hit that happened this quarter. Warrants are like options to buy stock later on. When their value changes a lot, it can cause big swings in reported losses. Overall, their net loss from continuing operations was about $5.5 million for the first 3 months of 2026. That is a big jump from a loss of about $1.5 million in the same period last year. Something else important here is the number of common shares outstanding. It jumped from about 5,000 shares in 2025 to over 1.6 million shares in 2026. This massive increase is likely due to converting debt or preferred stock into common stock and issuing shares for various deals. This significantly dilutes the ownership stake of existing shareholders. This table really shows the story of how they are trying to raise money and manage their ownership structure. Their additional paid-in capital, which is essentially the extra money investors put in beyond the stock's face value, soared from about $96 million to over $111 million. This is evidence of significant fundraising activity. However, their accumulated deficit, which is the total of all their past losses since they started, also grew from about $91 million to nearly $97 million. This highlights that despite recent revenue growth, the company has a long history of not making profits. They also issued 400 shares of Series D preferred stock in this quarter, adding $400,000 to their equity. This type of preferred stock often comes with special rights and can be converted into common stock under certain conditions. Now for the cash flows, which show the actual cash moving in and out of the company. As expected, their net loss is still very high, at almost $5.5 million for the first 3 months of 2026, a huge jump from over $17 million in losses in 2025. Remember, this is the accounting loss, not necessarily the cash used. The cash they actually used in their daily operations was about $1.9 million. This is better than the $3.5 million they used in the same period last year, but it still means they are burning through cash just to keep the business running. Where did they get cash from? Financing activities provided almost $5 million in the first 3 months of 2026. This came from things like exercising warrants, which is when people who hold warrants buy the company's stock. This is a crucial source of cash for them right now. And that financing activity helped boost their cash on hand from about $2 million at the end of 2025 to almost $4.9 million by the end of March 2026. Let's dig into some of the important details in the notes. Under the business acquisition section, they mention their acquisition of Family Beginnings PC in February 2026 for a total price of $760,000. This shows their strategy of buying other fertility clinics to grow. This section is critical. They openly state that there are substantial doubt about the company's ability to continue as a going concern for at least 1 year from the date the accompanying financial statements are issued. This is a serious warning that means they might not be able to pay their bills in the near future without more funding. They've historically relied on raising money through debt and stock sales, and they expect to need more. Past companies that have faced this warning, like Rite Aid, have gone through significant struggles. A $1,000 investment in a company with this warning might see a significant decline in value if they cannot secure the needed funds. They provide more detail on that Family Beginnings acquisition. The purchase price was split between cash and shares of their Series D preferred stock. This section discusses entities they have a stake in but do not fully control. They mention their joint venture in Alabama, HRCFG INVO LLC, where they account for their share using the equity method. Here is where we see details on their debt. They have related party demand notes from JAG and executive notes, some with high interest rates around 10% and financing fees. They also have a revenue loan and security agreement with a quite high effective interest rate, varying depending on when it is paid back. This shows they are relying on various forms of debt, some with potentially unfavorable terms. This is a busy section illustrating significant changes in their stock structure. They completed a 1-for-5 reverse stock split in March 2026. This is often done to boost the stock price to meet exchange listing requirements, but historically, reverse splits in smaller companies can sometimes precede further declines. Think of what happened with AMC or even some earlier struggles with companies like Kodak. They also increased their authorized common stock quite a bit, going from 50 million shares to 250 million shares. This gives them more room to issue new stock for fundraising or acquisitions. They also mention a November 2025 1-for-8 reverse stock split. This pattern of multiple reverse splits suggests they've been trying to manage their stock price externally. They have a lot of activity with warrants. Warrants give the holder the right to buy stock at a certain price. When they are exercised, it brings cash into the company, but it also means more shares are issued, diluting existing shareholders. The warrants issued in December 2025 were initially classified as liabilities because the company did not have enough authorized shares to cover them. When they reclassified them to equity, they recorded a big loss of over $3.5 million. This shows how complex accounting for these instruments can be and how they can impact reported earnings. Here they break down their business into 3 parts: clinic services, INVO device, and therapeutics. The therapeutics segment was sold off in mid-2025 to let them focus on clinics and the INVO device. For the first 3 months of 2026, the clinic services segment brought in about $1.98 million in revenue, while the INVO device segment brought in just over $32,000. The clinic services are clearly the main driver of revenue now. Their fertility clinic services segment revenue was about $1.98 million, showing the growth through acquisitions like Family Beginnings. The INVO device segment, however, is bringing in minimally, only about $32,000 in revenue. This indicates their strategy has heavily shifted away from selling the device itself and more towards operating the clinics. Looking at income before taxes for the first quarter of 2026, the total segment loss was about $1.7 million, with the majority of that coming from unallocated corporate expenses. This highlights that even the profitable parts of the business aren't covering the overhead. In the management's discussion and analysis, they reiterate their strategy of acquiring profitable fertility clinics and expanding their INVO device usage. They mention that revenue grew by about 23%, with most of that coming from growth at their Georgia joint venture and the addition of Family Beginnings. Their selling, general, and administrative expenses increased by about 40%, largely due to higher professional fees and personnel costs. This is a significant jump and outpaced their revenue growth. They report no loss from discontinued operations in 2026, a big improvement from a massive loss of $15.9 million in 2025, which was tied to selling off their therapeutics segment. This is where they lay out the going concern warning. They acknowledge they need more money to operate and grow, and that getting it may not be easy. This is a high-risk situation, and investors need to be aware that companies in this position can face severe financial distress. The cash flow summary shows they used almost $1.9 million for operations in the first quarter of 2026. The positive cash from financing, nearly $5 million, came primarily from warrant exercises. This cash inflow is essential for their survival. This part is important. They admit to material weaknesses in their internal controls over financial reporting. This means their systems for tracking finances are not strong enough, specifically mentioning a lack of segregation of duties and not enough staff to handle complex accounting. This makes it harder for them to ensure their financial reports are accurate and reliable. When companies have these kinds of weaknesses, it raises concerns about the accuracy of the numbers we see. Now, let me give you my take on all of this. INVO Fertility is clearly in a growth phase, aggressively acquiring clinics and trying to raise capital. The revenue increase is positive, showing their core business is expanding. However, the widening operating losses and the significant going concern warning are major red flags. They are burning through cash and heavily dependent on external financing, which, as they admit, is not guaranteed. The multiple reverse stock splits and the history of stock issuances suggest a struggle to maintain a stable stock price, and the material weaknesses in internal controls are worrying. The fact that the INVOcell device itself is generating very little revenue compared to their clinic services further shows their strategic shift. But it also raises questions about the long-term viability of that technology. The risk I am watching most closely is their ability to secure future funding. Without it, their growth plans and even their ability to continue as a business will be severely threatened. What I am actually looking for is a clear path to profitability and improved internal financial controls. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.